Good morning, all of you. I welcome all of you. Today's class is monetary policy and inflation. This topic is coming under Block 3, Unit 12. This particular unit consists of three different theories. One is monetary policy in India and fiscal policy in India. After that, inflation. What are the causes for inflation and what are the different types of inflation? So, in this particular class, we are going to complete the monetary policy. In the next class, we will discuss the fiscal policy. The main objective of this particular unit is to make the student familiar with economic policies like monetary policy, fiscal policy, and to understand the types and causes of inflation. Today's class is to the monetary policy. The Indian economic policy includes several policies, out of which the following policies are some of the major Indian economic policies. What are they? Number one, India's monetary policy, and second one is India's fiscal policy. And we have to see what are the role of this monetary policy and fiscal policy. Let's start with the monetary policy. Monetary policy refers to the steps taken by the Reserve Bank of India to regulate the cost and the supply of money and the credit also in order to achieve socio-economic objectives of the economy. Monetary policy influences the supply of money, the cost of money, or the rate of interest, and of course the availability of money also. One of the most important function of Reserve Bank is to formulate and administer the monetary policy. Such a policy refers to the instrument of credit control by the Reserve Bank, so as to regulate the amount of credit creation by the bank. It also aims at varying the cost and availability of credit with a view to influence the level of aggregate demand for goods and services in the economy. Professor D.C. Rowan defined the monetary policy in this way. How he defined? In his words, discretionary act undertaken by the authorities designed to influence the supply of money and the cost of money or rate of interest and availability of money. So these are the three things which include the monetary policy. So the monetary policy consists of three things. What are they? The supply of money. Number two, the cost of money or rate of interest. And the third one is the availability of money. So these three things should be regulated and influenced by the central bank. The objective of the policy is in India during the planning period, the basic objective of monetary policy has been to meet the requirement of planned development of the economy. With a broad and basic objective, the monetary policy has been pursued to achieve the following objectives of economic policy by the government of India. We will see one by one. The first one is to accelerate the process of economic growth. One of the twin aim of economic policy is to accelerate the process of economic growth with a view to raise the national income. The Reserve Bank has made an allocation of funds to the various sectors according to the priorities laid down in the plans and requirements of day-to-day development. So this was the main objective of monetary policy. And for that, we have to give some ancillary. So we have to control the expansion. The second objective is to control the prices and reduce the inflationary pressure in the economy. The monetary policy of the Reserve Bank during the planning period is approximately termed as controlled expansion. So under the head of controlled expansion, these are the things they have made. Every economy is facing a conflicting interest. What are they? The expansion of money supply to finance the process of economic development. But at the same time, control of money supply to check the inflationary pressure generated in the economy. As a result, The vast development and non-development expenditure will take place. Thus, the controlled expansion of money supply is essential for growth with a reasonable price stability. We cannot keep on supply the money because it may create the inflation situation. So we have to have two conflicting factors. So one is we have to provide required money supply, but that should not create the inflationary situation. So the Reserve Bank of India is adopting some measures to monitor the monetary policy. What are the measures that it is taking to achieve the objective of monetary policy? The Reserve Bank has adopted two measures. What are they? Measure for expansion of currency and credit. This is one side. At the same time, measure to control the credit also. Why? Because it may induce the inflation. So these are the two measures that the Reserve Bank is concentrating while implementing the monetary policy. First, let us start with the measures of currency and credit expansion. For meeting the development needs of the economy, the continuous expansion of currency and credit was required during the planning period. The revision of open market operation is the right tool to increase the money supply. In October 1956, the open operation policy of Reserve Bank was revised and it started giving discriminatory support to sale and purchase of government securities. Initially, the bank made a large purchase of government securities. In subsequent years, the bank selling the government security, which is exceeded its own purchase. Why? Because the excess sales method uh, make that particular economy to an inflation situation. So they discontinued between 1964 and 69, that is third five-year plan, with a view to expand the currency and credit in the economy. So the bank starts circulating more money for the public. Further, some measures have been kept. The second one is from 1991, liberalization of bill market scheme. The Reserve Bank has liberalized the bill market scheme. As a result, the commercial bank receive additional funds from the Reserve Bank to meet the credit requirement of the borrower. Since 1957, Reserve Bank was included to export bill. Also, the bill of particular market, that particular sector only. This in turn helped the commercial bank to provide credit to the exporter. For that purpose only, they have start giving money to the commercial bank. From central bank to commercial bank, the money is flow. Based on that, the export promotion activities has been taking place. The third one is the financing facilities to the priority sectors. This is another important thing. Why? Because even though the general policy of Reserve Bank is to control the credit expansion, still it continues to provide credit facilities to priority sectors such as SSI, that is small scale industries and cooperative and other agriculture allied activities because we have to increase the agriculture production. The bank has been providing short-term finance to the rural cooperatives also. Bank to bank, there is a credit. Then one more thing is refinancing and rediscounting facilities. This enhance the improvement activity towards the GDP. The Reserve Bank also follows some policy with a selective refinance and rediscounting facility. In recent years, the banks are permitted to refinance equal to 1% of the time and demand liabilities. How much it is having? 1%, it is meant for the refinance only. This is done at the rate of 10% per annum. The refinance facility is available for providing the food procurement credit as well as export credit. For these two purposes only, the refinance is allowed. For the rest of the thing, only normal finance. Because sometimes they are not able to meet the more than to meet. For that, the banks are allowed to extend 1% of its total deposit for refinancing activity. The scheduled banks can also get their bill of exchange or promissory note to rediscount the Reserve Bank finance. But the maximum duration of this bill should not exceed more than 3 months. It's a short-term loan only. For 3 months, they can give a rediscount facility for the borrowers. Then one of the main element of this monetary policy is the establishment of financial institutions. The Reserve Bank has played a main role in establishing various institution in the country to which the Reserve Bank provides a medium-term and long-term credit facility to everyone. Some of them I have listed. The first one is ICICI, Industrial Credit and Investment Corporation of India. The second one is IDBA, Industrial Development Bank of India. The third one is IFCA, Industrial Finance Corporation of India. Then the fourth one is IRCA, Industrial Reconstruction Corporation of India. Then SFC, State Finance Corporation. Then ARDC, Agriculture Refinance and Development Corporation. The last one is the most important one, NABARD. NABARD is National Bank for Agriculture and Rural Development. So, by establishing various financial institutions, we are able to regulate the monetary policy, either for medium and long-term credit, for refinance or rediscounting, based on depending upon the type of credit, it may use a different financial institution. Then it also have a tool called deficit financing. To continuously increase the supply of money in the country, the Reserve Bank has adopted the system of deficit financing for financing the budgetary deficit of the government. For this, the Reserve Bank have made changes in its reserve requirement and made the reserve system more flexible. The changes made by the Reserve Bank are the proportional reserve system, which is required to keep 40% reserve in the gold or foreign securities, has been dropped by the Reserve Bank. Usually, we have to keep the foreign exchange or we have to keep the gold for printing the thing. So it has been relaxed. The minimum reserve system. The minimum reserve system has been modified by the Reserve Bank. Now the bank need to keep a gold worth of rupees 115 crores. The requirement of keeping foreign securities value is rupees 85 crores that has been waived during the extreme contingencies. Thus, the extreme contingencies of bank need to keep only 115 crores reserve in the place of 200 crores. Then the next one is the allocation of credit. According to this measure, the allocation of credit will be done in accordance with the priorities laid out in the plan. Still, the major part of the credit goes to the public sector through statutory requirement and other means. For the priority sector, a certain minimum of credit at a concessional rate of interest is ensured through selective credit control and differentiate rate for in that particular scheme have differentiate interest. The Reserve Bank does not give credit to the private industries directly. These industries can get credit facilities through public financial institution, as we mentioned earlier in the fifth point. Now, let us move to the second part, the measure to control the credit. The Reserve Bank of India has a responsibility to ensure the money supply within the manageable limits as unlimited expansion of money and credit reserve, which result in inflation, which ultimately affect the poor. So, the Reserve Bank has been using credit control measures, which can be classified into two categories. One is called quantitative measure, the other one is called qualitative measure. We used to call it general measures and selective measures. General measure means quantitative. That is, these measures are generally adopted by the central bank in the almost all the country adopting this particular method. These measures adopted by Reserve Bank affect the lendable sources of commercial banks, which in turn affect the total volume of credit and hence the total money supply. So these measures affect the total quantity of credit in the economy in general. So the general control include few operations like bank rate, changes in the discount rate, and open market operation and cash reserve requirement, and SLR, statutory liquidity ratio. We will see one by one. The first one is the bank rate. The traditional definition of bank rate says that it refers to the rate at which the central bank discounts the eligible bills. In broader sense, it refers to the minimum rate at which the central bank provides a financial accommodation to commercial banks in the discharge of its function as a lender of last resort. During inflationary period, the bank rate is increased so as to increase the rate of interest on borrowing, so which may control the inflation situation. There are some changes that have happened in the discount rate. Some of the changes are make the cost of securing fund from RBI cheaper, more expensive. bring about the changes in the structure of market interest rate, and finally serve as a signal for the money market, business community, and public for the relaxation or restrain the credit policy. Because of these changes happened in the discount rate, the Reserve Bank has changed the bank rate several times from 4.5% in 1963 to 10% in 83 and further 11% in July 1991. It was 12% with effect from October 8, 1991. The increase in the bank rate adopted reducing bank credit and control inflation with effect from 29th April 1999. The bank rate is 9%, and in October 2001 it was 6.5%. In 2002 it come down to 6%. So there is a lot of variation in the discount rate. Why? Because in order to control the inflationary pressure as well as you have to provide the required money supply. So bank rate is one of the main tool to control the credit. And second one is the open market operation. The open market operation refers to sale and purchase of securities or foreign exchange or gold by the government. The central bank seeks to influence the economy either by increasing the money supply or by decreasing the money supply. To increase the money supply, the central bank purchases the government securities from the bank and public. Example, if the Reserve Bank buys a security worth of 50 crores from the commercial bank, then the Reserve Commercial Bank will increase by 50 crores. And this money will come in circulation. Conversely, when the central bank sells the securities to the bank, the deposit of bank would be reduced, resulting in contraction of credit and reduction of money supply. So this is the way the open market operation taking place. In India, open market operation are mostly in government bonds because of absence of treasury bill market in India. RBI has not used open market operation since long. From 1991 only, enormous inflow of foreign funds in the India created a problem of excess of liquidity in the banking sector, and the Reserve Bank undertook a large open market operation. In USA and UK, unlike in India, the open market operation is mostly the treasury bill. They are having the treasury bill and they played in a good manner, but in India, it is not so. We used to sell the government bond only. In 2001 and 2, the Reserve Bank sold the securities worth of rupees 1063 crores and purchased a worth of 49,068 crores of rupees we have purchased. That is why there is a wide gap between the sale and because we have to control the inflation situation. The third one is cash reserve requirement. The commercial banks in every country maintain a certain percentage of their deposit in the form of balance with the central bank. It is known as CRR, cash reserve requirement. If CRR is 10%, for example, the maximum amount of bank is lent equivalent to 90% of total reserves. The method of CRR is the most direct and effective method of controlling the credit. More the excessive reserve, the greater the power of Reserve Bank to create the credit and lower the power of commercial bank in creating the credit. On the other hand, it is made reverse. Lower the excess reserve, the lesser the power of Reserve Bank to create a credit and larger the power of commercial bank to create the credit. So it is vice versa. The Reserve Bank empowered to vary the cash reserve requirement between 3% to 15% of the total demand and time liabilities. Since 1973, the cash reserve requirement was 7% and 15% in 1991, and it was 14% in 1994. The CRR ratio was cut down to 11% with effect from August 20, 1998. This reduction due to new liberalized policy of India. Now, let us move to the SLR. SLR is statutory liquidity ratio. Apart from the cash reserve requirement, RBI Act 1934 all the commercial banks are required to maintain under Section 24 of Banking Regulation Act 1949 that the liquid asset in the form of cash or gold or export approved securities. This is known as statutory liquidity ratio, and it cannot be less than 25% of the total demand or time deposit liability. 25% they have to keep. The Reserve Bank of India is empowered to change this ratio. Accordingly, It raised the liquidity ratio from 25 to 38 with effect from September 1990. The two underlying reasons of rising statutory liquidity ratio are it helps to check the inflationary pressure of the economy by reducing the capacity of commercial bank to create credit. This is the first advantage that we have. The second one, it makes larger resources available to the government. In the view of Narsimham Committee report, the government decided to reduce SLR stages from 38 to 25%. So that committee recommendation has been taken, and now in the post-liberalization period, the SLR is 25%. And the last one is refinance policy. The refinance is given by the Reserve Bank of India to commercial banks, affect their credit, but this system is changed from time to time to allow or disallow the flow of credit from the bank. Over the year of effectiveness of refinance policy has come down because the dependence of commercial bank on Reserve Bank of India for refinance has come down except in case of subsidized refinance to the agriculture and rural credit. So this particular facility only meant for uh, agriculture activities or rural credit. So these are all the quantitative measures. Now we'll move to the qualitative measure. We used to call it the selective credit control method. That is selective control of credit. This control refers to regulation of credit of a specific purposes or branches of that particular economic activity. Selective credit control are controlled or considered to be the useful supplement of general credit regulation. Under Section 21 and 35A of Banking Regulation Act 1949, the Reserve Bank has a power to control the advances by banks related to number one, the purpose for which the advances may or may not be made. The second one is margin to be maintained in respect to secured advances. The third one, the maximum amount of advance to any buyer. And the fourth one, the maximum amount up to which the guarantee is given by the bank company on behalf of any firm. And the last one is the rate of interest and other terms of condition granting power. So these five, the RBI is having the power to regulate under the section 21 and 35A. For this purpose, the following six measures adopted by Reserve Bank. What are the measures? Number one, regulation of marginal requirement of loan. The second measure is regulation of consumer credit. Third one, rationing the credit. Fourth one, credit authorization scheme. The fourth one, some directives. The last one is moral suasion. So we will see one by one. These are the selective credit control method. The first one is regulation of marginal requirement of loan. The Reserve Bank fixes a minimum marginal requirement on loan for purchasing or carrying the security. Margin is the difference between the market value of security and amount lent by bank against these securities. The basic aim is to restrict the use of credit or credit to purchase or carry securities by the speculator. The minimum requirement of loan is what is the percentage value that the security which cannot be borrowed or lent. This is the purpose. In simple words, we may say it is the maximum value of loan which a person can get from the bank against the security. That should be some margin value. The changes in margin requirement regulates and control the demand of speculative credit. These margins are 20 to 100%, but the Reserve Bank can control the credit by increasing the margin or expanding the credit by reducing the marginal requirement. So this is one of the best method in selective credit control. The second one is about the consumer credit, how to regulate that. To check the inflationary pressure in the economy, another method of selective credit control is the regulation of consumer credit. This credit is generally given to the consumer for purchase of durable goods. The consumer credit schemes which are adopted by bank require a certain percentage of consumer durable goods paid by the consumer by cash. They have to pay some percentage income cash. The rest will be given by the bank as a credit. The Reserve Bank can control the credit by changing the total amount which it can be borrowed by the consumer for the purchase of consumer durable goods. The maximum period over this particular installment it can be extended. The Reserve Bank can control credit by increasing the down payment and reducing the number of installments. In other words, it can expand the credit by reducing the down payment and increasing the number of installments. This is the second method of selective credit control. And the third one is rationing of credit. Rationing of credit is another technique of selective credit control method. Under this method, the Reserve Bank fixes the quota for the member bank as well as their limit of payment of bill. The quota system is first introduced in 1960. If the member banks seek more loans than the quota, which is fixed by them, they have to pay a higher rate of interest to the Reserve Bank than the prevailing rate. So, rationing of credit is both quantitative as well as quantitative method of credit control. Why? Because it reserves deposits from the commercial bank in order to control the credit. It is not only qualitative but also the quantitative. If the ration is done with respect to total amount of loan, it will be a quantitative control. Then the third one is CAS, as we said, Credit Authorization Scheme. The Credit Authorization Scheme was introduced by Reserve Bank of India in November 1965. Under this scheme, the commercial bank had to seek authorization from the Reserve Bank before sanctioning the fresh limit of up to 1 crore or more in a single party. When you are giving loan more than 1 crore means you have to get the permission from the Reserve Bank. The limit has been changed from time to time. The limit is raised to 6 crores with effect from April 1986 since July 1987. This scheme has been liberalized to allow large amount of loan to meet the genuine demand of the production sector without price sanction of Reserve Bank. However, in such cases, a system of post-sanction scrutiny is called Credit Monetary Arrangement (CMA). It has been introduced by the Reserve Bank. Why? The main purpose of cash is to keep close watch to the flow of credit to the borrower because it's a single handle more than 6 crores. So we should monitor that. That is why monetary arrangement is made. And they will have a close watch about this particular transaction. It requires that banks should tend a large borrowing concern on the basis of credit appraisal and actual requirement of borrower. Whether he actually need that or not, they have to scrutinize and then they have to give. Then the fifth method is directives. Under this method, the Reserve Bank makes extensive use of selective credit control and issues directives to the commercial bank. Since 1956, the directive has been issued by the Reserve Bank. The first such directive was issued by Reserve Bank in May 17, 1956 to restrict the advances against the paddy and rice. Later on, so many other commodities common use were also included in the list. The state agencies such as Food Corporation of India, State Trading Corporation have exempted from use of selective credit control. The rest of the thing coming under this category. The last one is the moral suasion. The Reserve Bank has been using moral suasion as a selective credit control measure. Periodical letters are issued by the Reserve Bank of India to the bank, urging them to exercise the control over the credit in general or advances against the particular commodities or unsecured advances. So the regular meeting and discussion are also held by the Reserve Bank with the commercial bank to impress upon them the need for cooperation and effective implementation of economic policy. So Reserve Bank will have a moral persuasion or suasion with the commercial bank by communicating and providing periodical letters and conducting meetings with the commercial bank. So these are all the topic that we have covered so far. In the next class, we will continue the same unit with the fiscal policy in India. Thank you for watching my video. If you have any doubt, kindly ask or you can make a comment in the comment box. Thanks for watching my video. We will continue the next class with the fiscal policy in India.